In this video, I'm going to talk a little bit about the financial planning process. So to start off the financial planning process, there are kind of a couple of components associated with this that are important to note first. Among them, we have essentially cash planning and profit planning. And the reason why there's a distinction between the two is that from a cash planning standpoint, if I am planning big expansions or something like that for my business, I may actually need cash in order to pay for those. So I could be making plenty of money from a profit standpoint, but not actually have enough cash on hand in order to fund the growth that I'm looking at. So from a cash planning standpoint, we're going to look at a cash budget, the actual cash we expect to have coming in, the cash going out, and make sure that we essentially don't run out of cash and that we have the cash on hand that we need in order to implement the plans that we are trying to implement. Now, in the long run, we would hope typically for a business that cash would be flowing from operations and therefore from profit. But we can have lumpy assets where I have to buy big pieces of fixed assets or property, plant, equipment, things like that. That could cause some disconnects in terms of what's going on with profit on a regular basis and just sort of what's happening from a cash flow standpoint. So the cash planning piece is looking at, given what we're expecting to occur, what's happening for our cash budget, the money coming in, the money going out, making sure that's going to be acceptable. We're not going to run into any problems there. But then from a profit planning standpoint, this is going to invoke projecting out financial statements. So when you start projecting out financial statements, that's called those are called pro forma financial statements. So those are projected financial statements. So when I start shifting it a little bit of a longer term projection, I'm projecting out the actual income and balance sheets. And the idea there is as I grow my business and things like that, it triggers changes in the various assets and things on the balance sheet and so forth, which then triggers changes in funding. So for instance, if I'm going to sell 3 times as much product, I'm probably going to need to have more inventory. And if I need more inventory, that's an asset on the balance sheet, which means either liabilities or owner's equity is going to need to go up to pay for this, or maybe some other asset would have to go down to pay for this. But something is going to have to occur in order for this change to work out. And so that by the time you get to the profit planning piece, associated with increasing those sales, what that's going to do to my net income, what that then relates to my balance sheet. We actually have to project out all these different line items on the financial statements to pull it all together to figure out, okay, given what I think is going to occur, here's what that means for my broader financial situation here. Now, to really start this process, the main starting point is actually the strategic plan. So the strategic plan is going to be generated first. And really what that plan is going to be trying to answer is things like, what is the mission and vision of the firm? What is the firm's reason for existence? What are we trying to do here as a firm? And that may guide things, because if you start looking at the mission and vision of a firm, sometimes companies have evaluated themselves and they realize, we have this whole set of products and things like that they're good products, it's a good business, but this isn't really who we want to be as a company, and we don't really want to be focusing on that stuff. So sometimes they've actually sold that whole section off to somebody else and said, hey, it's a great business, good products. We don't really want to be in that business line. And so we need to move on from that. And really that starts to be driven by the mission and vision of the firm and kind of what the firm is trying to be and what its goals are and things like that. So you really have to answer some of those questions to start with. And then you start having to progress into things like, well, what are the impacts of general environment trends? When I say general environment, things like what's going on in the regulatory area, what's happening in demographic trends. We had the baby boomers that went through, and that really affected various economic activity areas and things like that. But you could also have other areas. Maybe people are wanting to buy more of certain types of products because they're into more health and wellness kind of products, or maybe they're buying more of certain types of foods because they think certain other types of foods are worse for their health, or maybe we look at various legal changes and so on. So there are lots of sort of general environment things that are kind of affecting the environment which the business is operating. And we need to be looking at those and kind of figure out how does that relate to my specific business and how does that impact me and what I should or shouldn't be doing to thrive in the current environment. Then you also have to start looking at industry trends. Is the industry in a growth phase, and so it's growing rapidly? Because my response in a growth phase is going to look rather different from if the industry is more of a mature industry with limited growth prospects. And generally what happens is you start off, you have a broader variety of smaller companies. When an industry is just kind of getting started, lots of little companies starting up, trying to figure this out. And gradually it tends to go from kind of startup into growth. We start getting some rapid growth. And eventually it starts to kind of start moving into, once I get into more of a little bit further along in the industry cycle, generally we start seeing a little bit more consolidation and not quite the broad variety of companies necessarily, but you get a little bit more consolidation until eventually you get to more of a maturity phase where you have, in many cases, more of a handful of more established players in the industry that are fighting over the increasingly more diminished growth. And eventually, if the industry kind of starts to hit a decline phase, then they're fighting over a shrinking pie of sales, as it were. And so you wind up with changes in terms of what makes sense for companies to do. Early on, it's all about growing and expanding and things like that. Later on, it might be more about trying to figure out how to cut costs and perhaps consolidate, make acquisitions so that there are bigger economies of scale, so it's possible to survive. So you have to look at kind of where in the industry life cycle is a company, and then you start looking at competitive trends. So even within that industry environment, how was the company positioned, or is the company kind of trying to target maybe a broad market with low cost leadership kind of products? So we're just trying to sell mass market to everybody kind of products, or are we trying to target more high end niche kind of a products? Are we serving a certain segment within the market? What kind of choices have we made? How do we relate to our competitors? Who is directly competing with us, who's not? And trying to figure out, maybe competitors are merging and that may be causing some risks for us. So trying to assess those kinds of things. Now, within all of that, one of the things you would then look at for a strategic plan would be, what is the sustainable competitive advantage of the firm? In other words, what can this firm do that in a sustainable way that is essentially better than the competition? Because that's what the company needs to kind of lean into. If they are particularly good at certain types of products and then they start getting off into other types of products, that could actually be a distraction, and they could actually wind up doing more poorly because they aren't actually focusing on what they're good at. And so if you're a company, you have to be kind of mindful of, what am I, the company, good at? And what gives me an edge over the competition? And let's kind of focus on that a bit. So we need to be thinking about those kinds of things. So once you kind of work through that whole strategic planning process, and this is just a wildly abbreviated sense of the strategic planning process. But once you've kind of gone through some of those kinds of things and you've gotten some of the answers associated with that, what kind of flows out of that then is a set of operating plans that you're going to develop to implement the strategic plans. In other words, you figure out who are we as a company, where are we going, what are we trying to do in light of this big picture, and out of that flows, okay, well now what do we need to do to implement kind of that strategic plan? And here's why that matters. You may conclude from a strategic analysis that some division of your firm, it's like, that's just on the way out. That whole area is a shrinking industry. We've had products over there, but that's just on the way out. It's just, there's not going to be growth over there. We need to get rid of it. Well, if that's the case, then when you get down to operating plans, your operating plans are not going to involve generally expanding and increasing investment in that area probably. And so you kind of have to look at that big picture and then figure out, well, what do we need to do on a more short-term basis to essentially walk out that strategic plan? And so generally when you're creating that operating plan, you're going to start with a sales forecast of what do we think we can produce from a sales standpoint. And you can use various other data too, looking at very economic data and circumstances, and looking at perhaps product level trends and things like that, even to try to figure out what a good sales forecast would be. But you can kind of start piecing that together, start looking at what kind of capacity you have in your firm. Do I have a lot of excess capacity to produce more products, or am I running at full capacity? So you're going to start with that, like a sales forecast, and then add in some of those other pieces about kind of how your firm is positioned. And ultimately, that means you're going to kind of put all that together to try to assess a cash budget and try to figure out, okay, well, given what I'm trying to implement and what I expect to have going on in terms of money coming in and going out, and do I have things set up such that I will have an adequate amount of resources, essentially. And what that's ultimately going to kind of then fit into as well would be trying to address various financial issues that arise as well. So if you do a ratio analysis, as I've discussed in prior videos, and if you concluded in your ratio analysis, hey, we've got way too much debt. Okay, well, then if I'm coming up with a strategic plan and then I'm trying to operation plans in pursuit of that, one of the things I need to address is, hey, we concluded we got too much debt. We need to like get rid of the debt or at least lower it. And so how are we going to do that? So if I've got some deficient ratios, some areas where things were not looking good, then part of my plan needs to address that. And so I need to think about, all right, what can I do as part of my plan to shift some of these things that don't look as good? And that's when you start projecting out results. And so one way of carrying that out would be to project out and create those pro forma financial statements. So in light of kind of a sales forecast, in light of some of that other data that you're looking at, and you know, what you think is going on in terms of, you know, from a cash budgeting standpoint, put things together to come up with, all right, let's project our financial statements and let's figure out what the implications are. So if you start projecting out your financial statements, you realize, you know what, based on my projections here, I'm going to need a certain level of assets that's here, but based on where I am now and what I think is going to happen, just based on my projections, my funding level or financing is going to be down here. Well, that means I can't get this level of assets if my funding is down here. So I'm going to need more funding to close that gap. And so the idea would be we're going to try to project the results, but then determine the implications of that and figure out, oh, it looks like based on what I'm projecting, I'm going to need more money to make this, you know, growth happen. And so if that's the case, then now we need to kind of incorporate, all right, well, if I need more money, if that's one of the implications here, where am I going to get it? And so that becomes part of our plan. Now I need to factor into my selling stock, am I issuing debt, what kind of debt? I need to kind of put that together. But all of that needs to happen in light of like what was my financial position that I got from like the financial statement analysis. Because if you conclude, you know, over the next few years, I'm going to need to raise a bunch of money in order to make this growth happen. But oh, by the way, when I evaluated my financial position, I concluded I've already got way too much debt. Okay, well, given the growth, what does it look like is going to happen to my debt ratio? And then evaluate, okay, does that mean that I have such a high debt ratio and given the growth I'm expecting, I don't think that's really going to solve that enough. And so basically that might mean borrowing money is a bad idea. Well, if that's the case, then you know, that's one of the implications of my analysis. Like borrowing money is not a good idea, but I need to address the fact I've got too much debt. Where am I going to get the money? And then it starts turning into, well, I guess I'm selling stock, or maybe I need to retain more earnings, or something like that. And so then it starts to address kind of your plan. So you have to look at kind of that big picture of what am I expecting to occur? How does that relate to what I have concluded about where I am today in terms of the problems facing my firm? But then, you know, what's the implication? What do I need to do about that then to make this plan actually happen? And all of that is ultimately to try to serve the goal of helping us make progress towards walking out that strategic plan. Okay, hopefully that gives you a good overview of sort of the financial planning process. Hopefully it makes sense. Thank you so much for watching and have a great day.